Hi, David Moore, Equity Advantage with Robert Smith, Peregrine Private Capital, and we're just going to sort of sum up things for this May session of 2023. Lots of fun out there. But I want to sort of leave people with a couple thoughts, and then Bob, you can sort of wrap it up and elaborate on them. But there's something called 1031G6 that I think people really need to understand. When you get into an exchange, and if you chose to terminate that transaction, there's only certain times where you can get money. First off, 1031 is not all or nothing. So if you want to take 10,000 out, go take a trip, do it. But you can only get it at close, and it would be specifically excluded from the 1031 exchange. And so, for example, if you're working with us, in our assignment agreement, there's a paragraph in there to ask whether you want to retain any taxable proceeds, if so, how much, and you write in there, and you're going to walk out of escrow without money. It's excluded from the exchange, and it has to be done that way. You can't just take money out because it jeopardizes your exchange, all right? The second part I'd like to really stress is 1031G6 says that you can only get money out of a transaction after you've purchased everything you have the right to buy. So that would be at no time prior to midnight the 45th day, and after the 45th day, only after you've purchased what you have the right to buy. So historically, we might have looked at DSTs as sort of a fallback, that's something you couldn't find anything else, and we're going to put that in there. But I really want to caution people out there, no matter who you're working with, don't ID a property on day 45 just because. Only ID it if you plan to buy it. Because if you identify a property just in case and you decide you don't want it, what happens if you find the perfect property on day 60? That exchange company by law cannot release your money until day 181. So it's critical that you understand that. And with that said, the DST is one of those things where it's a product that's available, as we discussed in one of the early segments today. These assets are things that DST sponsor owns. They're not waiting for a group of people to fill a bucket of capital to exercise that purchase. This is something that the sponsor owns, and you have that right to, and you can close it, boom, like that. But Bob, and I guess one thing I'd like to say too is the nature of our investor going into these things has sort of changed through the years. Historically, it might have been pieces or the 11th hour deal. But last year, I think we had one guy that had literally $30 million of property that all went into that DST product. And that's a different thing. So you mind sort of wrapping up today's segment, talking a little bit about that DST space and how you've sort of seen change through the years and what people are doing with it today?
Yeah, that's a very good point, David. Having helped create the DST with the Inland Group, 21 years ago, I think we can lay claim to being the oldest retailer in the space, or longest lived retailer in the space. And the profile of the investor has changed profoundly over that period of time. As you just mentioned, it used to be kind of a backup product, bits and pieces, small capital increments going into DST. It was new, it was untried. Fast forward 21 years, the product itself has matured very well. It's gone through several purchase and sale cycles successfully, and so the capital aggregates that are going into DST simply get bigger and bigger and bigger, and that's also in no small part driven, in no small part is demography the driver of that. Because the population's getting older, and managing your own dirt in your 20s, 30s, 40s, and maybe even 50s is okay. It's not okay, so okay in your 60s, 70s, and 80s, because unlike a stock or bond portfolio, real property, income property is actively managed. It takes lots of time, lots of energy, and as you get older, you're probably going to be running down that way, and you're going to be looking for something, an ownership format that better reflects your more laid-back, retired lifestyle, and that's where DST comes in. And that's one of the reasons why there are bigger and bigger capital aggregates going into DST, is because it now has a track record, and the population of income property owners is 20-some-odd years older. And and as such, property programs, the better property programs, don't remain on market very long. Granted, transaction velocity has slowed down the last year, and we told people a year ago that's coming. We told people, hey, look, we're at a market peak because you've had an unprecedented decade or more of zero interest rates. That's going away. It's not coming back. And as soon as interest rates go up, sales are going to slow down. But even with a slower sales cycle, we're seeing the better DST programs are soared very rapidly. And because they are not open-ended like REIT, there's a finite amount of equity available in each DST program. And once that's fully subscribed by investors, the product leaves the marketplace and is replaced by another. So the idea of, well, I can use this as backup, that's probably not the best bet at this point in time, because there's a good chance that, oh, well, this didn't work, now I'll go to my DST. I'm sorry, the DST isn't there. And so DST works very, very well if you've done your homework and you're committed to the property and you want to execute on it. Otherwise, it's probably not such a good idea. So, it has the DST product and the DST space, which used to be ancillary to the broader commercial real estate market, is now a market of its own with a life of its own. And that life is very vigorous. And so if you're going to look at it, you better do your homework and you better be prepared to act, because if you don't, it probably won't be there. That makes sense?
So, yes, it does. And just for the benefit of our audience, what are the sort of the hot commodities in that space right now?
Well, we think, we are very, very biased and have been very biased for quite some time to self-storage and senior living, simply because historically, according to NACREIF, the National Commercial Real Estate Investor Fiduciaries, self-storage is the number one performing CRE, commercial real estate property type. The last 20 years running in terms of total return, income plus appreciation at about 16.8% annualized. Number two is senior living at about 14.6, 14.7, and multifamily follows up somewhere just north of 13%. And we spent most of last year, from a time and energy standpoint, rotating out of multifamily properties that we bought or placed investors in 4 or 5 years prior to that in high growth markets like South Florida, Orlando, Nashville, other parts of Tennessee, parts of Texas, and rents went up so far, so fast over that interval that we felt it was timely to sell, because no tree grows to the sky. Rents had become prohibitive in many markets, and so they were overdue for a correction. And operating assets like multifamily sell largely on the basis of cash flow. And if cash flow is going to go down, then there's a strong likelihood that your property value will go down. And we are now in that correction phase with multifamily. So we opted to dodge that bullet last year and encourage our investors to look at less richly priced asset types like self-storage and senior living. And I think so far we've largely been validated. For better or worse, the dominant property type in the DST space continues to be multifamily, simply because multifamily is, most people that are considering the DST option are selling some type of rental housing, whether it's a single family home, duplex, small apartment building, so they're already familiar with the property type and comfortable with it. And it's a much easier sell for a broker, or a much lower hurdle for him or her to get over to sell you something or place you in something you're already familiar with, as opposed to try to educate you about something that you're not familiar with, even though historically those asset types might outperform. So the majority property type is still multifamily, albeit we do not think it is right now, at least in terms of the near future, the strongest property type. But that's our opinion, and I'm sure there are lots of people that feel differently. But those are the two property types we feel most confident with because we're going to be entering a recession shortly, the Biden recession. How long that lasts, how severe it is, anyone's guess. And historically, because of the demand drivers for those two property types, they have proved very recession resilient or resistant, and we think that's the safest course of action for investors at this point in time.
Thank you, Bob. So we try to provide content that we feel is going to be helpful and informative to you. And you've got a variety of ways you can reach out to us. The only dumb question is the one you don't ask. So if you've got questions, we do get comments on the videos. But if you've got questions, please don't hesitate to reach out to Bob. Give him a call because we can go dance back and forth forever in texts or emails. And
he's lonely.
Yeah, he's lonely. But it's just we can cover so much more real estate with a phone call than we can any other way. If you've got questions on something we've spoken about, you think it would be a good video, please don't hesitate to reach out. Also, we love to have you sort of let us know what's important to you. And thank you so much for joining us today, Bob. It's been a lot of fun as always.
Davey, it's always fun.
Yep.
It's always fun.
Thank you. David Moore, Equity Bench, and Bob Smith, Peregrine Private Capital. Thank you.